From bonds to Bitcoin, the rules of money are changing. Episode 77. I'm fired up. It's going to be a great episode today. We got a ton to talk about. A lot is happening. Things are changing. The world is moving. And I even pulled together some very unfortunate data and storytelling of my backyard to break down today's topic. Humanize it, make it relatable, help you understand it. The very place I grew up is in shambles.
That's Jack Mallers laying down a thesis that's bigger than Bitcoin tribalism. The world's reserve asset, U.S. Treasuries, has been bleeding out, and portfolios built on that foundation are wobbling. Today, we're unpacking Jack's argument, checking the receipts, and mapping what this shift means for pensions, 401ks, and yes, Chicago. Over the last half-decade, long treasuries suffered an historically long drawdown. Multiple sources put it at approximately 5 years, the longest on record, because yields surged from near zero, crushing price. That's not internet hopium, it's the scoreboard. Jack also slams liquidity. Try selling size? That's not crazy either. The structure has changed. Hedge funds' basis, trades, and non-traditional buyers are important at the margin. When issuance or risk appetite flips, depth gets patchy fast. The Financial Times has been documenting this fragility all year.
The world reserve asset has historically, in recent memory, in this new post-1971 dollar, has been bonds. However, bonds, as we've talked about a lot on this show, have been getting obliterated. Scoreboard. Last 5 years, bonds have been getting smoked, destroyed. Because as I've said, I fundamentally believe we are entering a new monetary area, a new monetary regime. I think this post-71 fiat world is ending. It's eroding. Bitcoin is escrowing us into a new era of prosperity, of monetary prosperity. So this tweet from Charlie, the U.S. bond market has now been in a drawdown for over 5 years, by far the longest in history. And you can look at bondholders, where again, the vast majority of wealth at the nation state level, at the corporate level, the pension level, which we'll talk about. This is where everyone's long-term capital has been stored, their savings. Their savings account has been getting obliterated.
60-40 is dead, says Jack. Strong words, but the pain is real. When the 40, bonds, falls with inflation pressure, it stops hedging equities. And the 60? Strip out the Mag 7 and the S&P 493 has been slogging along with low single-digit net income growth expectations this year, barely beating headline inflation.
Oh, it breaks my heart. Oh, it breaks my heart. You know, this is the Jack Mallers Show HQ. You're looking at a beautiful picture of the sunset over the Chicago River. Let me make the pitch of Chicago to you guys real quick. Summertime shy, they say. There's nothing like summertime Chicago. Why? We've got our own body of water. We have our own lake, and that lake creates a river that you're looking at. It goes right through the heart of the city. Okay, so we have our own bodies of water, our own beaches. We have a professional sports team in every major sport. We have our own golf courses. Okay? We have major state and local universities. Chicago University, U of I, University of Illinois, Northwestern, the Big Ten. Phenomenal schooling. We also have our own financial market. My grandfather was the youngest ever chairman of the Chicago Board of Trade. And really, this city, we pioneered risk transfer on top of agriculture commodities. Okay, what that means is the commodities, not like gold, not like Bitcoin, the commodities agriculture that we consume, that we produce, that we farm, and that we eat. The soybean pit, the wheat pit, the corn pit, right? You don't want your corn farmers speculating on the future price of their crop or wondering if it's going to rain or not, or if people are going to enjoy more corn in their burrito or less corn in their burrito. You want them to just farm and produce healthy crop so that we don't get sick and that we're eating healthy nutrients, right? And you want to transfer that risk to a healthy financial market. And that's what Chicago pioneered. It was not a market of speculation. It wasn't a market of penny stock insider trading. It was a market based on principles, on economic growth, on nutrition. It was beautiful, right in the heart of America. And this city has gone to shit. My hometown. Fuck. This episode's going to pain me. But it's one of the greatest cities in the world. Brick by brick, salt of the earth, middle of America, middle class, integrity, honor, principles, our own water, sports teams. Michael Jordan, you used to be able to get a steak on this river and bike down the road and watch Oprah Winfrey and Michael Jordan eating a steak. And now this city is falling apart due to monetary policy, fiscal irresponsibility, too much government, and a bunch of bullshit.
Facts check out on the fiscal squeeze. The city faces about a $1.1 billion projected budget gap for the coming year. Regional transit agencies are staring at a approximately $770 million fiscal cliff without new support. And CPS wrestled with a deficit initially pegged at $734 million before trimming it closer to $569 million by early August. That's the math Jack is reacting to. Pensions are the powder keg. After Springfield's latest benefit sweetener, City Analysis and S&P flagged that Chicago's police and fire funds could drop toward approximately 18% funded versus approximately 70% national averages. That's dire. And the asset side? Chicago office values are being marked down hard. Select towers have sold at steep discounts, 50 to 70% off peak in some deals, even greater than 70% in cases, while national office pricing still trends lower. That pressure filters straight into tax bases and pension portfolios. Jack's doom loop explainer is clean. When the savings vehicle is long-duration bonds and struggling CRE, your reserve asset isn't reserving much.
Trump signed this executive order on Thursday that allows, we talked about this, Bitcoin in 401ks. It's Bitcoin and gold. Okay? This was a huge, huge, huge deal. How do you begin to solve this? How do you fix the savings that are so severely underwater? Individuals, families, businesses, states, pensions, endowments. How do you save their savings? Open up their 401ks to Bitcoin and gold. The only way you can get out of this is by diluting the currency, debasing the dollar. And you have to make sure people can own the winners. I'm telling you guys, this is what is happening. I promised you. In my opinion, this is absolutely what's happening.
This one's huge. On August 7th, 2025, President Trump signed an executive order directing regulators to allow cryptocurrencies and other private assets in 401k plans under guardrails. Coverage from CNBC/CBS, Kiplinger, and IBD all align on the core change. The door just swung open for BTC and gold in defined contribution plans.
Bonds are dead. The 60-40 portfolio is dead. These endowments, these pensions, these sovereigns, they have to start owning something else. This, I cannot overestimate how big of a deal it is that Harvard bought over $100 million worth of Bitcoin exposure. This is long-term capital preservation. This is the creme de la creme for long-duration bonds, for commercial real estate, for a bunch of bullshit legacy fiat crap. That's the Harvard endowment. That's the Chicago pensions. That's a bunch of the biggest sovereigns in the world. They can't live on bonds anymore. The largest cities in America are eroding. They're eating itself. 5 straight years of bond losses. Commercial real estate marked down 85%. To me, this was the shot heard round the world. Trump opening up 401ks to Bitcoin and gold exposure is massive. It is a direct attempt to save the savings accounts in this country.
Jack calls this the shot heard around the world. The filing backs him up. Harvard's endowment disclosed 1.9 million shares of BlackRock's iShares Bitcoin Trust, IBIT, valued at about $116.7 million, plus $101.5 million of SPDR Gold Trust, via 13F as of mid-August. That's real institutional signaling.
Another massive deal that if you were to tell me a year ago, 5 years ago, 10 years ago, I would have never believed you. Fed quietly publishes bombshell article discussing gold revaluation. The idea has come up in the context of helping to establish a strategic Bitcoin reserve or a sovereign wealth fund. So the Fed went out and published an article that talked about revaluing the gold on their balance sheet.
Jack references a Federal Reserve note on revaluing gold and hints it could help fund a Bitcoin reserve. Important nuance: the August 1st Fed's note surveys international experiences with revaluing official reserves like gold FX and how governments sometimes use revaluation proceeds. It does not endorse buying Bitcoin. It's an analytical piece on mechanics and fiscal implications. Still, the timing alongside the policy shifts fueled plenty of speculation.
So shifting to some macro before we move on. So we had talked about this before, government preparing to IPO Fannie Mae and Freddie Mac. This is a massive liquidity injection into the U.S. markets. Again, the Treasury and the United States is going to need to find ways to inject liquidity into financial markets. And this was one of the obvious ways. Trump had been hinting at it, and now it's official. So Trump seems to confirm 2025 timing for the IPO. So the government had taken these businesses over. Now they're bringing it back to the private markets and then taking it public. So it's all a little bit confusing. But the point is that they're bringing tremendous amount of liquidity. Like, guys, this is trillions of dollars of liquidity. We had done an episode earlier. You guys can go back and listen to it, where I had estimated, just based off this administration's plans and what they had been projecting, somewhere in the order of $10 trillion of potential liquidity. And I had I nicknamed it 3 COVIDs.
Jack ties in the rumored Fannie Mae Freddie Mac IPO, administration signals, and reporting suggests late 2025 is on the table, with proceeds estimates around $30 billion from a partial sale. If it happens, it adds to the run-it-hot liquidity mosaic Jack describes. First, flows into DC plans. If plan sponsors and record keepers actually enable Bitcoin and adoption follows, allocators will have a sanctioned channel. Watch large plans, IPS updates, and menu ads. 2. Institutional positioning. Harvard's 13F is the canary. Do we see more endowments shark foundations disclose IBIT FBTC? 3. Bond stability versus cuts. If the Fed Treasury architecture engineers rate cuts and liquidity that stabilize long bonds, the 60-40 is deadline softens. If not, and if inflation pops on stimulus, Jack's case strengthens. 4. Chicago data. Do funded ratios and deficits improve? Or do new taxes chase the base away while assets keep bleeding?
So, man, it just sucks, man. Because, what am I? I'm looking around man, I'm going to have to move to Texas or something. And it's not a slight on Texas. I mean, Texas is operating in a surplus. But you literally got me thinking man, my whole life is here. This is the United States of America. My city, where I was born and raised, is like a third world country. Crime everywhere, underfunded police force. Chicago, the public school district is a mess. Don't know where to educate children. It's dirty. It's like, okay, well, what's going on? How do we fix the problem? Oh, all the pensions have a giant bag of bonds and commercial real estate. So how do you want to fix that? You're going to tax me? You're going to make me pay for it? You're going to take my Bitcoin? Yeah, fuck out of here.
Agree or disagree with the maximalist edge, Jack's core point lands. When the reserve asset of the fiat era breaks, everything built on it shakes. Policy is now actively creating on-ramps to alternative reserves, Bitcoin and gold, in mainstream retirement accounts. Endowments are testing the water, and hometowns are feeling the cost of getting the reserve asset call wrong. If you liked the video, do not forget to like, hit subscribe, and leave a comment. Thank you for watching, and I will see you next time.